The investor received the first call from a public payphone, a method chosen specifically to avoid detection. These calls contained market-moving information that appeared legitimate but was carefully manipulated. The pressure to act quickly on this information created a psychological trap, bypassing normal due diligence. This pattern mirrors common financial fraud schemes, where urgency overrides rational decision-making. Each subsequent call escalated the stakes, creating a false sense of exclusive access to privileged information. The secrecy surrounding the calls prevented verification with trusted colleagues or standard financial advisors. This isolation is a hallmark of financial manipulation, where victims are kept from external perspectives. The relentless pursuit of advantage blinded the investor to the mounting inconsistencies in the information received. The financier's aggressive strategies involved high-frequency trading and leveraged positions that amplified both gains and risks. Privileged information in such environments typically flows through private meetings, encrypted communications, and exclusive social networks. This case demonstrates how financial pressure can create incentives for information asymmetry, where some participants gain unfair advantages. Market-moving decisions at this level often involve billions in capital and can trigger chain reactions across global financial systems. The intense period described represents a common pattern in financial scandals, where pressure leads to boundary erosion. Access to non-public information becomes particularly valuable during market volatility, creating temptation for those positioned to exploit it. Such environments often feature complex relationships, where professional and personal boundaries can become dangerously blurred. The mechanisms described follow documented patterns, where financial success creates both opportunity and vulnerability to ethical compromise. The investor's strategy centered on rapid, high-conviction bets, a method that prioritizes speed and certainty over prolonged analysis. This approach often involves making significant financial decisions based on a limited window of perceived opportunity, bypassing traditional, slower due diligence. Such high-conviction strategies are common in volatile markets, where the first mover can capture outsized gains before a trend becomes widely recognized. The mechanism relies on identifying a signal, a piece of information, or a pattern that the investor believes others have missed or undervalued. Once identified, capital is deployed aggressively into the chosen asset or position, creating a concentrated portfolio rather than a diversified one. This creates a high-risk, high-reward profile. Success can yield dramatic returns, while being wrong can lead to equally significant losses. The strategy's reliance on speed often necessitates discrete and immediate communication channels to execute trades before information spreads. In this context, even anachronistic tools like a public payphone could serve as a secure, untraceable node in a communication chain, away from digital surveillance. This required information, often non-public, market-moving information. The pursuit of this edge was a central part of his operational model. Such information typically involves data not yet available to the general public. Market-moving information can significantly alter stock prices or investment decisions upon release. In financial contexts, an edge refers to a competitive advantage gained through superior knowledge or analysis. Operational models in business or finance are structured plans detailing how advantages are systematically pursued. This pursuit often involves accessing data through networks, research, or privileged channels. Such practices highlight the tension between competitive strategy and ethical boundaries in high-stakes environments. The use of a public payphone represents a deliberate attempt to avoid electronic surveillance. This method creates no direct billing records linking the caller to specific numbers or locations. Unlike mobile phones, payphones don't generate cellular tower pings that can track movement patterns. The physical distance from personal devices reduces digital footprint and metadata collection. In financial contexts, such extreme measures typically indicate concerns about transaction tracing. This avoidance pattern mirrors methods used when individuals seek to obscure communication chains. The choice represents a calculated trade-off between convenience and operational security. While increasingly rare, public telephones remain available in certain urban and remote locations. The financial losses began accumulating rapidly, creating a cascade of failures across multiple investments. These failures resulted from a combination of factors including poor information, miscalculated risk assessments, and unfavorable market conditions. The payphone communications did not directly cause the financial collapse through supernatural means. Instead, they represented part of a broader behavioral pattern that significantly increased financial exposure. This pattern involved repeated high-risk decision-making that amplified vulnerability to market fluctuations. The communication method itself created additional layers of operational risk and information gaps. When combined with flawed investment strategies, this created a perfect storm for financial disaster. The mounting losses revealed how communication patterns can compound rather than mitigate financial risk. The financial losses were severe and public, often involving complex investment vehicles like hedge funds or private equity structures. These vehicles collapsed when underlying assets failed or market conditions shifted dramatically, similar to patterns seen in historical financial crises. The investor's personal wealth evaporated rapidly as portfolios were liquidated and assets were seized to cover obligations. This loss wasn't just numerical. It represented years of accumulated capital, trust, and professional standing disappearing overnight. Public exposure came through regulatory filings, court documents, and media reports that detailed the scale of the failure. The professional reputation was permanently stained, making future ventures difficult as trust in the investor's judgment eroded. Such collapses often follow a pattern: over-leverage, lack of diversification, and misjudgment of risk, leaving little room for recovery. The dissolution marked not just a financial end, but a profound personal and professional reckoning for those involved. Bankruptcy in this context extends beyond financial ruin to include reputational collapse, where public trust is permanently shattered. This dual destruction often occurs simultaneously, as financial mismanagement becomes public and erodes professional credibility. The critical unknown element here involves the content of payphone conversations, which remain undocumented and unverified. Payphones historically provided anonymity, making such conversations difficult to trace or corroborate through conventional records. This information gap creates significant limitations in understanding the full scope of events and motivations involved. Common misconceptions arise when observers fill these gaps with assumptions rather than documented evidence. The absence of concrete conversation records means key details about agreements, warnings, or revelations remain speculative. This pattern of missing communication records is not uncommon in cases involving private discussions in pre-digital eras. The "sold his soul" metaphor describes a desperate bargain where someone trades integrity, privacy, or legal safety for a perceived advantage. This is a common pattern in scandals, where individuals compromise core values under intense pressure or ambition. Without verified evidence, we cannot assume any actions were explicitly illegal. The focus should remain on the human decisions and their consequences, not on objects like the payphone. Misinterpreting mundane items as inherently sinister can distract from the real psychological and relational dynamics at play. These dynamics often involve obsession, betrayal, and the dangerous keeping of secrets. The real scandal lies in the erosion of trust and the calculated risks people take when they feel cornered. This analysis avoids supernatural explanations, grounding the story in verifiable human behavior and its documented patterns. The tool was selected specifically for its anonymous nature, allowing communication without revealing identity. This anonymity is a common feature in many digital communication platforms used worldwide. The true tragedy lies not in the technology itself, but in the interpersonal circumstances that made such concealment appear necessary. Similar patterns occur in relationships where trust is broken down, creating environments where secrecy becomes normalized. This narrative lacks a complete judicial resolution, as many real cases remain unresolved in public records. Without documented legal proceedings, specific confessions or convictions cannot be confirmed in this instance. This reflects a common reality, where relationship conflicts often occur outside formal legal systems. The focus remains on the human dynamics that lead to such situations, rather than technological details. Operational secrecy often signals excessive risk in financial schemes. Complex mechanisms to avoid transparency typically indicate underlying vulnerability in the system. This pattern appears across various financial scandals, where elaborate concealment precedes collapse. The quest for an unsustainable competitive edge can blindside even experienced professionals. When a strategy depends on consistently having secret knowledge, it creates inherent instability. This approach builds fortunes on foundations that can vanish instantly when secrecy fails. The pressure to maintain such advantages often leads to increasingly risky behavior. These mechanisms demonstrate how the pursuit of exclusive information becomes a liability. The financial collapse described demonstrates how liquidity and leverage operate as double-edged swords. Liquidity refers to how quickly assets can be converted to cash without significant loss of value. Leverage involves using borrowed money to amplify potential returns, but it also magnifies losses. When wealth is tied to highly leveraged, illiquid positions, there is no financial cushion during a downturn. This creates a scenario where the fall is total, as seen in rapid financial collapses throughout history. The same methods used to build a fortune, aggressive leveraging, and illiquid investments, can lead to its destruction. This pattern is observed in various financial crises, where overconfidence and leverage precedes collapse. It serves as a stark reminder that financial strategies must account for both growth and risk management.